In today's episode of episode 6 of the E2 Beginners Trading Bootcamp, this is probably an episode that a lot of people are going to be looking forward to because I'm going to be talking about the fun part of trading, which is looking for your entry confirmations. You guys know now that you're looking for support and resistance levels or areas or zones to be trading, and you know how to determine trends, so you're trading with the trend. Now, entry confirmations, entry models, there's a lot of them, but in my personal experience, in my trading, they don't matter as much as you may think. You can go and back test, but entry confirmation, entry models, again, they're not going to make an insanely big difference to your win rate. What matters most is context. Make sure you're trading with the trend. Make sure your structure is drawn correctly. Make sure you understand the difference between internal and external structure, and understanding when to trade and when not to trade. Good conditions versus bad conditions. Those, purely from my experience, do affect your win rate more than just the entry confirmation. Nonetheless, let's get into the entry confirmations. There's different ways of determining your trade, but we'll go over the most basic one for you guys beginners out there. This is the most basic entry confirmation there is out there. So higher lows, higher highs. Remember, this is all internal structure. I already showed you guys this actually in the previous episode. Basically, you're looking for this change of character. Now, I marked this as an internal change of character because it's an entry model. We're looking at internal structure, not external. If you're looking at external, of course, you would be flipping your high time bias to shorts in this case. But this is just trading an internal with a confirmation. So you can see we break structure or make a change of character. And basically what you do in this case is you have two ways of entering this. Once we create this internal change of character, you can either immediately enter with a buy stop, meaning you enter as soon as that low gets taken, and your stop loss is always going to be covering that high if you're shorting. If you're longing, it's always going to be covering the low because this is when your trade is invalidated, right? And I'll have a separate section, maybe next episode, where I talk about trade management, stop losses, TPs, but this is the general gist of how your trading should be. All right. And again, this is your number one potential way of entering. Number two potential way of entering is draw a 50% tool of the leg that broke the internal change of character. Have your limit order set at 50% of that leg, because this is what I used to do back in the day before my new system I developed that I teach y'all. But this is the most beginner friendly method of entering trades, and it can't work as long as you have the right context. Just wait for price to come out to 50% and you have your limit order. If you don't understand what a buy stop, sell stop, limit order is, I'm going to explain that in the next episode. Hence why I'm making this episode extremely short. I'm just showing you basically what you're looking for on a lower time frame in terms of structure and entry. You either immediately enter off this break here, or you wait for price to come out to 50%, mark the range, and enter here. There's pros and cons real quick to each of these entry models. The pros of entering immediately off the break is you never miss a winning trade or a great setup. The con is your risk reward ratio is not going to be ideal. You probably don't understand what that means yet. Again, covered in the next few episodes. In this case, same thing. If you enter here, you're never going to miss a winning trade, but your risk reward is going to be cut in half, basically because your other entry model is entering at 50%. So your stop loss is cut in half. So your risk reward is going to be double, but you do miss more trades. So this is something you want to look at your net RR total from your backtesting, and I will have a separate bootcamp video discussing about backtesting and the best ways to basically look forward to backtesting. Best ways to approach backtesting is the right word I was looking for. So yeah, just a quick little video going over entry models, basic entry models you guys can use. I'll give you guys a few quick examples here real quick. So here's an example real quick. All right. You can look for, basically we took out these highs, right? This is a sweep, whatever you want to call it. And now you want to trade a reversal. Low that made the new high. We broke the low here. Let me draw out the low, holding control and shift, making a straight line. Entry type 1 with confirmation. Stop loss, remember covering the high because this is when price is invalidating your trade idea. There's your TP. TP is your take profit. You choose demand. If you're in a short and counter trend, you want to be TPing at demand. If you're taking pro trend trades, meaning going with the trend, you TP ideally at the next swing point, which is the weak points, weak high or weak low. This is example number 1 of entry model 1. Now let's do the 50% method. This is entry model 2. You can see 2.17 risk reward versus 0.9. So basically a 2 times risk reward difference here. Except keep in mind, price is not always going to come out to 50%. It's something you have to backtest, collect data on, see if you're comfortable missing these trades, and see how much it affects your net risk reward. Because if you're missing way too many trades, at some point it might be better to just take the 1-to-1 and cash the trade. So that's an example of using both entry models. We'll look for a long example now in this case. As you can see, it's not picture perfect. It's not going to always work out. This is a high that made a new low that literally got broken. This is your entry type model 1, no pullback. And your TP is going to be at the high, obviously, because it's pro trend. You can see price does some weird stuff here, but look at the time. This is something that's, this is a more of an external situation here because of time. Market's going to close. This is not something you would be trading anyway at this time. But nonetheless, for example, if you took this, this is the right way to approach this setup here. And if you're waiting for another entry confirmation, this high made this low. So then you wait for this high to get broken, which is right there. And then, aim for the high. So this high that got broken, you enter right here. Now, here's the thing. Sometimes you have to add some discretionary decision making here, which you can also convert to mechanical by identifying when to do what. In this case, if you have a rule for yourself that your stop loss is too big, a certain size, or your risk reward is very bad, have a rule where maybe you have your stop loss placed somewhere else mechanically identified. Or have your stop loss maybe placed as a rule where you just go for a 1-to-1. Or you have another rule where you wait for 50%. Here's a perfect example. Price does never come back. Price just never comes back to 50% here. So you will miss this long opportunity here. Now, those are 2 entry confirmation models you can use. Beginner ones. And this is the last entry you can use. This is actually not in confirmation. The last entry you can use is obviously you draw your supply or demand or support and resistance, buy low, sell high, and you just have a limit order at your zone and target the structure. In this case, it protects you from actually getting stopped out early here. That's the benefit of limit orders. You tend to get stopped out less, or stopped out less if price goes in your direction. That's what I mean, because you avoid these internal sweeps here. But that's another approach where you can enter trades using just pure limit orders at your zone. So for example, you can have your limit order here at your zone, however you mark it, go for a TP. Now in this case, this is not a smart idea. You're trading against the trend. You're trading with a weak high above you. You don't want to be taking shorts until the weak high gets taken. Weak high gets taken out here. You can have a limit order right above that and have the thing with limit orders is you need more breathing room for price. If you have a zone or structure, you can find a pretty solid area to cover. But if there's like nothing above, meaning like there's nothing above really here much above these highs, at least here prominently, then you need to just kind of have to figure out a mechanical method of identifying where you put your limit order. So that's the kind of like the downside of limit orders is stop loss placement is going to be a little bit more iffy at times, especially when we have liquidity sweeps. But when you have confirmation entry models, so for example, we take out the highs. I think we take out here. This low made this new high. Entry type 1, right? You break it, you enter here, stop loss at the high, and you target demand. So something down here. And there's your like 1 to 8 risk reward, almost 2 risk reward. You can see in this case, no example where price does not come back to 50%. You missed the move, right? So just something you want to balance. There's no right or wrong in this scenario on which one you want to trade. Obviously, if there's no edge that you've done backtesting on when you don't wait for 50%, obviously you don't want to trade that. Make sure that it has an edge in the first place. Otherwise, you ditch it and try to refine your system. But hopefully, those tips helped you guys out there in terms of, finding entry models, the 2 entry model types basically, and the third one is just using limit orders. I'll see you guys in the free Discord server, man, and stay tuned for the next episode.